Well, good morning, everyone, and welcome to the latest quarterly webinar update with our Chief Economist, David Bassanese. My name's Blair Modica, and looking forward to having a great discussion with you today. Before we kick off, really important to note that the information in this presentation will be general in nature and does not take into account anyone's personal financial circumstances. So please seek a financial advisor if you do have any personal financial questions. Just before we get going, I wanted to make a note that this will be a very conversational type of webinar. More than happy for everyone to please place their questions in the bar on the application, and we will get to them at the end of the discussion. A recording will also be sent to each and every one of you after today's proceedings, so you can re-look at anything that was discussed during the session. I also wanted to make note of some of the great content we try and put together at Betashares. So many of you will be familiar with the Bassanese Bites, which is David Bassanese's economic update and macroeconomic piece every week. We also put together a lot of material on social media, whether it's through Twitter, Facebook, Instagram, or YouTube. So please give that a look. A lot of interesting ideas, and keen to hear anything that you might like to see from us as well. And just a little bit about Betashares, and you've probably seen this slide a number of times before. What you might have noticed today is a little bit of a rebrand with a new logo. Still the same old Betashares with respect to being the only Australian founded and managed ETF provider, managing over 25 billion in terms of assets under management with almost 80 different exchange traded funds. So hopefully something there for you, and I really appreciate you joining in today and looking forward to a great discussion. If we move forward to the next slide, I'd love to introduce my colleague, David Bassanese. He's going to give you a market update, talk about the chances of a soft landing and perhaps what else is being priced into the market. So I'm going to hand over to him now. We're going to talk for around 45 minutes and then we'll get to questions. David, welcome.
Thanks very much, Blair, and great to be with you all again for the quarterly update, the first of the new year. And a lot's been happening in the last few months, and I'll give you an update on the state of play, and I guess my views on the outlook, albeit a lot of tensions in that outlook. And so here's the agenda today. Where are we? I'll give you an update in terms of the economic and financial market situation, and then a bit of a look forward in terms of interest rates, the Aussie dollar, in terms of equity markets, the outlook there, looking at earnings and valuations, and then some of the thematics within the equity market, what sectors, what regions are doing well and doing not so well, and how that might play out over the next little while, next few months. So with that, where are we now? So you may have seen this in the past. I have used this sort of metaphor, I guess, in the past. We're really in a race against time. In a sense, inflation globally and including Australia is high. At the same time, labour markets are tight, and central banks are very worried that the longer they allow inflation to stay high, or the longer it does stay high, the greater the risk that it feeds through to wage and price setting behaviour. And what was hoped to be a temporary period of inflation due to the COVID disruptions becomes a bit more ingrained of the type that we saw in the 1970s. Now, whether you think that's a material risk or not, that's sort of the way the central banks are thinking. And so they are raising rates. They are trying to slow the economy, ideally not create a recession. But if it takes a recession and get inflation down, that's what central banks say they're prepared to do. And so it's a race against time. Can inflation come down quickly enough before the activities of central banks do cause a material slowdown or global recession? And I would say just on that, we have some encouraging news over the last few months, and one of the reasons why equity markets have rallied since late last year. They've had a bit of a stumble in the last couple of weeks, which I'll get into, but it's really in that framework we are starting to see signs of inflation peaking, particularly in the United States. And so far, at least, the US is not in recession. So a lot of talk about, the US going into recession, but the activity numbers have actually been holding up pretty well. And in fact, just in the last few weeks, the early reads for January were a lot stronger than expected. And so we've actually gone from fearing a recession to fearing the economy could be overly strong, and the Fed may need to raise interest rates, the US central bank raise interest rates a lot more to slow that economy, and then eventually potentially creating a recession down the track. So, and we've seen bond yields go up as a result. And just so, and really, so it really does boil down to these various scenarios. And you're thinking about the equity versus bond market implications. So last year was a period where bond markets and equity markets didn't do too well because you had aggressive central bank interest rate increases, which hurt bond markets. It pushed up bond yields. When bond yields go up, the value of bonds goes down. But also that higher interest rate put downward pressure on equity valuations. It also hurt the equity market. And the scenarios for this year can really boils down to hard landing, soft landing, and no landing. The hard landing is the policy tightening that we've seen causes the US economy to go into recession. Now that would be good news for bonds because it means there wouldn't be a lot more tightening to come, and in fact central banks would then start to cut interest rates. Wouldn't be good news for equities because a recession would mean corporate earnings get hit. So a recession scenario, and in fact I've got still a 50% chance on that, means bonds are looking good here, but equities not so much. Now the soft landing, what everybody wants is that inflation in the US particularly can come down without having that recession kick in. We don't need a recession to get inflation down. If that happens, yeah, the Fed won't need to tighten aggressively further, but also corporate earnings won't get hurt too much. And so that's actually good news for both bonds and equities. And that's sort of been the environment we've been. So that's been the environment we've been in for the last couple of months, at least up until recently. Markets have been hopeful that, inflation in the US can come down and we maybe don't need to have a recession. So bond yields were falling, so that was good for bond returns, and equity prices, equity valuations were rebounding as well. Just in the last few weeks, the other scenario, of course, is that we get neither a slowdown in the economy, or at least a moderate slowdown in the economy, and inflation coming off, but we get continued overly strong growth and inflation proving stubbornly high, in which case central banks will have to do a lot more work. And it's actually a rerun of last year in that sense. So the no landing scenario is as I said, it'd be like a repeat of what we saw in the first half of last year. And that's sort of where markets have just started to get a little bit worried of late. As I mentioned, we've had some data in the US over the last few weeks. January payrolls result, service sector surveys have been positive, and the inflation numbers for January are a little bit higher than expected. So that decline in inflation that we saw through the last quarter of last year has just slowed a little. The rate of decline has slowed a little. So now just on that, before I get into a lot of other things, there is one thing that did happen in the US in January is that the winter, they have a very harsh winter. I lived in Boston for a few years a while back, and I do know how harsh the winters can get on the east coast of the US. And the winter so far has been milder than expected. Some attribute it to global warming and whatnot. We've got a shift of weather patterns. But the winter in Europe hasn't been as bad as feared, so they haven't had to use as much energy as they thought, which has helped energy prices come down. But in the US, it's meant that economic activity has held up better. So although we've seen some strong numbers in the US of late for January, there is still, it could still be a weather-related factor. So we could go back into see signs of a slowing and move back into a sort of soft landing scenario potentially. We just have to see how the data plays out beyond January. So just with that caveat, if you've been watching the data, reading the financial, watching the financial news of late with those stronger numbers in the US, has benefited from somewhat milder winter at the moment. So just in that, this is one of the critical, as I said, in terms of the race against time, you've got core, this is core consumer price inflation in the US. You can see that it's been coming down. So the total in orange, that's the total private consumption expenditure deflator, a bit of a mouthful, but it's the Federal Reserve's preferred measure of underlying inflation. And you can see it's gone from under 2 prior to COVID. It leapt up through 21, 22 to over 4%, driven by increases in goods prices. And it just started to roll over more recently with goods prices coming off. But at the moment, housing inflation has offset that through the course of 22. But as you can see, look, on a year-on-year basis, it hasn't been much of a slowing, but nonetheless, it's not. It has, I guess, gradually started to roll over. Now, the good news is that goods prices should continue to fall, and so this grey line should continue to fall back towards zero. I mean, the usual state of play with goods inflation in the US is that it's pretty weak. So housing inflation is still running at a strong pace, but we do know that market rent, this is a measure of average rents of everyone who rents in the US. We do know that market rents are falling. So with a lag, or rents on new leases, so with a lag, that will start to flow through to the housing part. But it leaves this stubborn component, which is core services ex housing, which is really underpinned by wages growth. And that hasn't demonstrated much signs of a slowing at the moment. And in fact, we just got a reading on this very measure on Friday. And one of the reasons why the US market sold off on Friday is that the numbers for January were a bit higher than expected. And it's showing that this core services ex-housing component of inflation in particular has remained stubbornly high. It was actually up 0.6 in the month of January. So this is the challenge, and really the debate about a soft landing. If you just focus on this black line, the Fed won't be happy. The Fed will only be confident that inflation is going back to target if services ex-housing starts to show a notable decline. And just on that, this is a chart of that same measure of inflation against average weekly earnings. So it's a measure of wages growth in the US. And you can see the two go hand in hand in large part. And it's hard to get, and one of the concerns with the Fed is it's hard to get service inflation down, this orange line, without a decent decline in wages growth. And so the idea that the US can get a soft landing really boils down to, can wages growth come down without a recession, without the unemployment rate having to go higher than where it is now, around 3.5%. Now, history is not kind to the soft landing scenario. As you can see here, we've never had a material downgrade in earnings after have accelerated without a recession kicking in. So it's never sort of fallen back of its own accord. So it could happen. It's never happened in history. And that's why, look, on the balance of probabilities, I still see more of a hard landing likely for the US. The only question is how much Fed tightening will be required to generate that downturn, because so far, at least, the economy has held up in the face of the interest rate rises to date. So that is really the challenge for the soft landing scenario. But I am open-minded. I'm watching the wages numbers. And if we do start to see some good progress on the wages front, then the soft landing scenario may well become the base case. And I think back to COVID, when we debated all the various scenarios coming out of COVID, a very weak recovery, a V-shaped recovery was thought the most optimistic scenario, but the least likely. And it turned out the best case scenario was actually the one that panned out, that V-shaped recovery, because the vaccines arrived a lot more quickly than expected, and also consumer spending bounced back pretty quickly. Households didn't go into their shell once they were, the lockdowns ended. So the best case scenario did emerge post-COVID, and so I don't rule out a possible soft landing scenario as well, but it is going to be critically dependent on these wages numbers. Just a market update in Australia. You can see here, like the course of last year, equity markets are under pressure. We actually bounced back pretty well through the second half of last year, almost back to our previous highs, and that was because the areas like financials and resources held up okay, whereas areas like technology, of which Australia is a small component, we have a small share of technology, got smashed because of the increase in interest rates. So that sort of favoured our market. You see bond yields were rising. Bond yields haven't really fallen a lot. They will look like they were falling for a while, but they've gone more into a sort of sideways pattern at the moment. But I guess the good news at least is that bond yields have stopped rising to the same degree that we saw in the first half of last year. Aussie dollars had a rebound, and again goes to what I was saying earlier. Since about late last year, around October, November, US inflation has peaked. It has started to come down, and the markets have been trading on a soft landing type hope. So it's been bullish for equity markets. It's been bullish for the Aussie dollar, and not so, and bond yields, at least for a time, were coming down as well. Australian economy, look, we're still going along okay. We are starting to see signs of a softening. Consumer spending was a bit weaker in December. We do get an update in 15 minutes on retail sales for January, so we'll see to what extent they bounce back in January. But fair to say that consumer spending is, I think, broadly speaking, slowing. Consumer confidence is certainly weak on the back of higher interest rates and weaker house prices. And employment growth, the last couple of months, we've had negative employment growth. More so than even in the United States, the interest rate increases from the RBA are starting to have some impact on economic growth. As you would expect, I mean, as I've been pointing out over the past year, our economy is a bit more sensitive to short-term interest rates, because debt levels are higher, certainly housing debt levels are higher, and more of our mortgages are variable mortgage rather than fixed rate mortgages. So a given increase in mortgage rates, a given increase in variable rates has a bigger impact on household cash flows than it does in the United States, where most households with a mortgage have locked in fixed rates. So it happens with a more of a gradual, impact on that economy. So that has been the state of play at the moment. The unemployment rates ticked back up a little bit to 3.7. House prices have continued to be falling. So nationally, as at the end of January, they were down 9.7%. I think there's probably more downside there. And really, we've got probably, I'm getting ahead of myself a little bit, but we've got a few more rate rises, I think, from the RBA to come, particularly given the fact that inflation, as you can see here, the trim mean, the latest reading for inflation in Australia, again, was pretty high. Now, there's a big debate in Australia about goods. Is it all supply driven? Is it just cost pressures? It's not reflecting wages growth or strong demand. In reality, it's a combination of all of these things. Consumer spending is up until recently unquestionably been strong. Wages growth hasn't been that bad. It's still been fairly benign. But the strong demand has meant that the cost pressures that businesses have faced, higher food prices, higher energy prices, have been passed through to consumer prices pretty easily. And so profits have held up as a result. But it is a combination of supply and demand factors that are driving that. And ultimately, again, as I said, what the RBA is worried about is the impact on inflation expectations if inflation stays high for longer. So even if it is driven by supply shocks, cost pressures, it almost doesn't matter what's causing it provided if it stays high enough for long enough because of that risk to inflation expectation. So that's the thinking of the Reserve Bank, at least. In terms of the economic outlook, we are hoping for a soft landing. I'm still quite hopeful that even if the US does have a recession, we can avoid a recession. We did get an important read on wages growth last week. The wage price index for Q4 was only up 0.8%. The annual rate was at 3.3, even a little bit less than what the RBA was expecting for that report. So it is true that generally speaking, wages growth in Australia is picking up, but it's still not at a level that is a big concern in terms of it contributing to inflation. So should our economy slow, too much, should the US economy start to drag us down, the RBA can change course and start to cut interest rates if need be. So that gives me ultimately the relatively benign situation with regard to wages in Australia gives me some hope that we can avoid a recession even if the US can't. And these are some of the projections from the RBA. They do have the unemployment rate gradually rising over the next couple of years to just over 4%. They've got the unemployment and inflation, should start to come down. And in a lot of cases, I mean, again, you think about inflation, it's the rate of change in prices. So even if prices have gone up a lot, all you need is prices to stop going up. So they may stay high, the price level, but provided prices stop rising or don't rise as much as they were, the rate of inflation will naturally start to come back down again. So I think we can have some confidence that we are close to the peak of inflation and it will start to moderate over the course of the coming year. As I said, house prices, just a snapshot of what's going on around the country at the moment. So in Sydney, we've had the biggest decline up until, so this is as at January, 14% peak to trough decline there. So we're actually looking at, and you can see it here, these are the declines in prices from their peak levels. And so we're getting up, Sydney is approaching we actually had a bigger sell-off over 2018, but we're getting close to that level at the moment. So, we're looking at a pretty chunky house price decline. But I think nationally house prices could probably decline another 5% from here over the next 3 to 6 months. But that is based on the RBA raising rates another 2. I've got them raising rates 2 more times, and markets are pricing actually 3 more times. But I don't think house prices can really stop falling until the RBA stops raising rates. But that would be consistent with that 10 to 15% ultimate decline in national house prices that I've been anticipating really for the past year or so. Anyway, at the moment, we're 2/3 of the way there. And one of the challenges for our market, this is mortgage repayment ratio. So I won't go into the details a lot, but it just shows you that the decline in prices that we've had, so house prices relative to income have declined, but it's been more than offset by the increase in interest rates, such that mortgage affordability has actually continued to go up. So the increase in interest rates have more than offset the decline in house prices. So even though prices are down, it's still quite hard to buy, the average household to be able to, buy a home at current prices. So that's why they're likely to remain under downward pressure. Just in terms of globally, we've seen business sentiment weaken, but at the moment it's not at recessionary levels. So far so good. Just a range of manufacturing indicators around the world. So even in the US, look, it's down, but it's not as low as it got during COVID or during the GFC over a decade ago. Similarly in Japan, China, in fact, you've got to always take the Chinese numbers with a grain of salt, but the big other news story I should mention at this point is that the China, they were dealing with they had a zero COVID strategy through much of last year. Anytime COVID reared its head, they would lock down cities, nail people, the doors shut of people's apartments so they couldn't get out, all this sort of drastic stuff. But they are reopening. So China's going through a wave of COVID at the moment, but the economy is starting to come back. So again, that's another positive for the global economy. I don't think we'll offset, if the US does eventually have to go into recession, I don't think we'll offset that, but at least it's helpful at the margin. Other big stories that Germany, Europe generally speaking has dealt with the energy crisis due to Russia's invasion of Ukraine pretty well. They've economized on energy use. Milder winter has helped, so their demand for heating has not been as strong as it normally is, and they've been able to source energy from other areas, the United States and Asia in particular. So, in fact, as I'll show you later, the European equity market has had a pretty good run over the last few months. It's been one of the strongest performers with the market rebound since late last year. Global market update, similar story. Equity, so US markets had a rebound of late. It's just started to pull back of late because of the strong numbers in the US and the fear that the Fed may need to do a lot more tightening. You've seen bond yields back up as well. But the broader picture here has been the markets have had a rebound in the last few months on the hopes of a soft landing. And also you've seen the US dollar weaken after having strengthened through most of last year. And that's what saw the Aussie dollar strengthen for a period there as well. But again, just in the last few weeks, you've started to see the US dollar strengthen in line with the weakening of the equity markets and the bounce back in bond yields. The big challenge for us, of course, is that when the US sneezes, we tend to catch cold. So in terms of our outlook, I mean, we are still beholden in large part to what happens in the United States. So every bear market in the US, where the S&P 500's had a 20% decline, we've tended to follow suit. Last year was a major exception. The US market at its lows was down 25%. We're only down around 15% at our lows, and as you can see, we almost fully recovered that loss. So far, at least, we've held up pretty well. But again, the US equity market has another leg down. I wouldn't count on that continuing. So I do see more downside than upside risk for the equity market over the next 3 to 6 months. Similarly for the economy, this is the US unemployment rate and the Australian one. US recession's in grey. And so typically when US goes into recession, their unemployment rate goes up 2 to 3%, and our unemployment rate can go up by a similar magnitude. So the global businesses many major businesses now operate on a global scale. So when they have a significant weakness in the US, they tend to cut back around the world, and so business cycles can be correlated. So that is the challenge so I'm more worried about the US impact on our economy than the RBA impact. We can go into I'm sure there are questions about mortgage resets, and there's a lot of households that are going to face a switch from fixed to variable rates, something like up to 800,000 households. It's still only 10% of households. It's a big number, but it's 10% of households. I do think that will help to slow consumer spending, but I don't think in and of itself it's going to cause a recession. But what happens in the US may do that. But that's when I think the RBA can come to the rescue to some extent. Interest rates, so this is where so just in terms of interest rates, Aussie dollar outlook. So the markets at the moment, these are what the markets are pricing in for the US and Australia. So you've got, basically the markets are toying with 2 to 3 more interest rate increases in both the US and Australia. So we're at 3.35 at the moment, and the markets are now pricing a cash rate just over 4%. And the US, they're at a higher level, and they've got the markets are pricing in a cash rate just over 5% as well. So again, on the back of the strong data in the US over recent weeks, the markets have basically gone from pricing in 2 more Fed rate hikes to 3 more. And similarly, we've sort of followed suit. My base case is I've still only got, RBA could easily go by three more rate rises, but I think we're going to see enough evidence of a slowing in consumer spending here. And particularly, and helped by the reality that wages growth at the moment still remains quite benign. I don't see a case for them to do 3 rate rises, but I think they will still do 2. I'm completely open to the possibility they could do more, but that's how the markets are positioned at the moment. Just in terms of bond yields, I mean, I won't go through the calculations a lot, but I've got a bond model. This is down here. So I basically model bond yields based on where the current cash rate is and what the market expects that cash rate to do between now and 12 months time. So at the moment, the Fed funds rate is at 4.6%, and the markets over the course of 12 months think it's going to go up by 0.5%. And you can see it here. That's the Fed funds expectation. So February 24, they see it being here. So with that degree of tightening, my model suggests bond yields should be around about 3.8%. And in fact, they're at 3.87. So it's a pretty good model. So when I think about where bond yields will be in a year's time, and now I'm talking about US bond yields here, I ask myself, well, where do I think the Fed funds rate will be? And what do I think the market will be expecting that cash rate to do over the following 12 months in 12 months time? And at the moment, so I've got, yes, the Fed will raise rates, but increasingly the markets will start to price in policy tightening, policy easing, and they'll focus on these rate cuts. And so for example, by the end of this year, I think the Fed will have cut rates on the back of the economy slowing, and the markets will then be pricing in even more rate cuts, such that my model would have bond yields going down from 3.8 back down to 3. And in fact, on my modeling, getting back to 2.5 by June next year. So that's how that comes about, how I come about with my bond forecast. But it is, dependent on a little bit more tightening, well, a little bit more, two more rate rises, but then rate cuts, and the market's starting to focus on rate cuts. Similar story in Australia. So the bond yields are around about 3.8%, and the RBA, I've got them raising rates twice more, but then the market's starting to price in rate cuts, and that will help to bring down bond yields. So that's it on terms of the bond yield front. I won't, just in the interest of time, I'll cut to the Aussie dollar. This is my model of the Aussie dollar. You can see it's pretty good, and it really driven by relative interest rates, the US dollar, what you think is happening with the US dollar, and iron ore prices. And bottom line, I've got the US dollar strengthening. You can see it here, the US dollar index, the dotted line, and you can see we talk a lot about iron ore, we talk about interest rates, but ultimately the broad direction of the Aussie dollar is at the mercy of the US dollar against global currency. So when the US dollar is broadly strong globally, we'll tend to be weak against the US dollar. And you can see that through the course of last year, the US dollar was strengthening. It's on this axis, and it's an inverted axis. So when this dark line is falling, it means the US dollar is strengthening, and we saw the Aussie dollar weaken accordingly. And then with that weakening of the US dollar since late last year, the Aussie dollar's bounced back again. But I've got the US dollar strengthening, ironically enough, because if the US does have a hard landing, there'll be a risk-off environment, and people will flow back into the US dollar as a safe haven trade, and that won't help the Aussie. But that is the principal reason why I'm more favouring a lower Aussie dollar than a weaker Aussie dollar over the next 3 to 6 months. If it's a soft landing, I'll repeat, go back to those original scenarios. If we do get a soft landing, US dollar will weaken, iron ore prices will strengthen, commodity prices generally will strengthen. The Aussie dollar could easily rally up to 80 cents. So it is, dependent on those what scenario will play out for the US economy. In terms of the equity market, so this is an important chart because this just shows you the snapshot of the challenges facing the US equity market, and hence all equity markets around the world. So with that rebound in prices since late last year, the PE ratio for the market, the price to earnings ratio, has gone from around about 15.5 at the lows of late October back over to 18 times earnings. So that's less than where it was at the end of 21. But from a long run perspective, that's still above average. The long run average is around about 16, in fact. But also note, though, if you look at the equity risk premiums, if you take that PE ratio, you invert it, you turn it on its head, you get the earnings yield of the market, which is here in black. You take away the 10-year bond yield, you get what's called the equity risk premium, or a measure of the relative value of the equity market to the bond market. And you can see that premium has now shrunk to about 1.7. Relative to a long run average of 3.5, 4. So the equity market on a relative valuation to the bond market is more expensive now than it was when the markets peaked in early 22. So, so as you can see, so yes, the PE ratio last year was at 22 times earnings, but bond yields back then were only 1.5%. Today they're 3 point, a full 2%, 2 and a bit % higher. So that is a valuation challenge for the markets. Even in a soft landing scenario, unless you get pretty substantial rate cuts, the market from a valuation point of view is looking a bit pricey. The other challenge, of course, is that earnings expectations have been falling. And so you can see here the market's expectations for companies in the S&P 500. This is a rolling estimate from analysts of what they expect the level of earnings to be in 23. And you can see since the middle of last year, they've been downgrading those earnings expectations, such that at one point the market expected earnings in 23 to be 10% above the earnings in 22. You can see it here. But that gap has shrunk such that now they expect no growth in earnings in 23 over 22. but they do expect a bounce back next year, and it's actually over here. They've got a 12% growth in earnings in 24 relative to 23. Now, if you get a recession, earnings won't be flat this year. They'll be down 10%, possibly 20%. So there is more downside to the earnings outlook in a hard landing scenario. So the US, as the title says here, the US, if you do get a recession, then the equity market certainly isn't priced for it because of the valuations situation and the still soft landing scenario that's being priced in terms of equity earnings. Look, I'll just cut to, I won't go through the breakdown of all of that, but I'll just show you the situation in Australia. Our valuations aren't as bad. The equity risk premium is down around 3.1. It is a bit below its average, but not as much. But the challenge here is we've got a pretty flat earnings outlook, principally driven by an expected decline or fallback in energy and mining sector. You can see it here. This is a breakdown of earnings growth by calendar year, by financial year. And so at the moment, our markets are expecting the financial year, which has only got 6 months to go in it, or even less, to grow by 7%. But next year, they don't expect much growth. So over the next 2 financial years, analysts don't expect much growth in overall earnings for our market. And that's because they see materials and energy in particular earnings are falling back somewhat. So overall, the earnings outlook here is pretty flat. Equity themes, and I'll just conclude on this in the final 5 minutes or so that I've got. So just to summarize, look, where we are, like in terms of interest rates, Aussie dollar, I mean, there are 2 to 3 more rate rises to come by the US, by the Fed and the RBA, but thereafter, I think the market, that's priced in, and I think the markets will then start to focus on rate cuts. So I don't see bond yields going a lot higher than where they are now, and probably over the next 3 to 6 months coming down. On the hard landing scenario for the US, I see the Aussie tending to weaken as well. In fact, it's weakened back a bit over the last few weeks. In terms of the equity market outlook, again, it is challenging under that scenario, particularly given where valuations are. Now, if you get into equity themes, firstly, just in terms of commodity prices, it's a pretty mixed picture. I mean, we saw maybe somewhat, I mean, the energy boom that we had last year was really a first half of last year's story. So this is a broad index of commodity prices. You can see that they rose through the course of 22, but by the second half of the year, they were starting to come off again. So oil prices have come off, agricultural prices, they haven't fallen in a big way, but they've sort of flattened off. And that was because, I guess, for a while there, we had the fear of a hard landing in the US. And now with the hope of the soft landing, they've had a bit of a bounce back. If you look at iron ore prices, they've actually been consistently, they weakened through the course of last year on the back of the Chinese lockdowns, the slowdown in the Chinese economy. With the China reopening, hopes of a soft landing for the US economy, you've seen iron ore prices bounce back again. But again, it's all dependent on how the US plays out. I'm not super bullish on commodities because of that, I think the challenging outlook in the US. So what does that mean for sectors? You can see here, this is some major sectors. Energy has generally done well through the course of last year, but then had a pullback. Healthcare, and what we basically, the themes from a sector point of view through last year, over the first half of last year, energy, financials did well because of rising interest rates, strong commodity prices. Technology did badly because of rising interest rates, and that hurts the tech sector, but that had a bit of a bounce back more recently. And healthcare, which was doing well through this period of equity market weakness, has pulled back in terms of relative performance because it's a defensive sector. It's had a pullback with the equity rebound of late. So that's been the push-pull factors in the markets. What do I think? I mean, I think I would still play this from a defensive point of view. So in terms of areas that are going to do well over the next 3 months, I actually would anticipate healthcare bouncing back somewhat. I think energy and banks are going to remain under pressure. And I think technology, broadly speaking, will stop underperforming once we get that peak in bond yields. So even if the economy weakens, if it's consistent with bond yields no longer rising, I think the tech sector at least its relative performance will start to level out. In terms of factors, you've seen cyclicals start to do well, growth rebound relative to value. You can see quality. These are companies with a high return on equity. They got hurt by the tech growth sell-off last year. They've had a nice rebound since late last year. I actually think quality can sort of hold up along with technology in a relative sense once bond yields do start to roll over. So that's from a factor point of view. But again, I'm not counting. I'm tending to fade some of this movement in growth and value because I do worry about the US outlook. So this soft landing rebound in these areas, I think, may well start to unwind. In terms of regional trends, we've seen US underperform since through the course of most of last year. Again, on the back of the technology sector globally underperforming and the non-US parts of the market outperforming. And actually, if you break it down, we had Japan doing very well through the early part of last year. Then that started to unwind, and this is the relative performance of Europe. As Europe tended to get on top of its energy crisis, we had a very strong relative performance bounce back in Europe just since late last year. Australia's done broadly okay as well. You can see it's tended to be outperforming, but again, I think we are going to be under pressure. But going back to this slide, I mean, things that helped us was the energy sector, the commodity sector, and banks doing well through the course of last year because they tend to benefit in a relative sense from rising interest rates. But if you do get that hard landing, I think these areas will unwind, and so I'm loath to think that the Australian performance can continue. In fact, you know, a defensive sector regionally may well be Japan in that environment. Look, that's all I wanted to cover. So just to summarise, you know, we've had some good news, some encouraging news over the last few months in the sense that inflation in the US has peaked, and so far at least the economy has not gone into recession. So the markets have traded on the basis that we could get a soft landing until proven otherwise. Just in the last few weeks, we've got some stronger data in the US that suggests not only may it not get a recession, but the economy may remain too strong, and central banks need to do more policy tightening. We'll wait and see, but I think some of the strength in those numbers in January could be driven by the better weather, the milder winter. But I do anticipate the Fed raising rates 2 to possibly 3 more times nonetheless, which eventually I think will probably see the economy still go into recession in the second half of the year, that unemployment rate going up. Because ultimately, going back to one of those very first slides that I mentioned, ultimately I see it hard for wage inflation to come back all the way back to where it was pre-pandemic without a decent increase in the US unemployment rate from where it is at the moment. So that soft landing scenario, again, possible, but history is not on our side in that regard. I'll leave it there.
Beautiful, David. Thank you very much, and great job on timing. Perfect timing. So we'll have about 15 minutes for questions. I think maybe to kick off, and please continue to send your questions through. There's a heap of them on the screen and more coming through as I speak. But one sort of recurring theme we've had, Dave, with respect to questions is just a very high level overview of what is a soft landing and what is a hard landing for people that don't know. Maybe that's a good place to start.
Yeah, so I mean, there's no hard and fast. A hard landing basically is a US recession. Now, for those that don't know, I mean, the US has a funny situation. There's a group in the US called the National Bureau of Economic Research. It's like an economic think tank, and within that group, there's a committee called the Cycle Dating Committee of all things. And their job is to look over the economic data, and when they think there's enough signs of weakness in the US economy, they will issue a press release, or they'll basically announce that they think the economy's gone into recession. And then they will announce when they think the economy's gone out of recession. So they have a committee of economists who look at data and proclaim whether the economy goes into recession or not. In Australia, we have the technical definition of 2 quarters of negative economic growth. And unless that happens, we kind of say we don't get into recession. Now, I think that's a bit probably not as good a measure, because you can still have a period of economic weakness and a rise in the unemployment rate without necessarily having 2 quarters of negative growth. You could get 1 negative quarter, then it bounces back, but then the following quarter is negative. So the way way I think about a recession in Australia is when the unemployment rate goes up by at least 1%, but more likely 1.5 or more. That's how I would define a recession here. But in the US, a hard landing is basically a recession. And in a recession, you get the unemployment rate going up, typically 2 to 3%, often more. So at the moment, the unemployment rate in the US is at 3.5%. So a hard landing would be that to go to, say, 5.5%, if not 6.5%. So quite a notable shift in the unemployment rate. Now, what is a soft landing? Historically, a soft landing is when the economy slows, unemployment stops falling, levels out, but you don't get a recession. So there have been periods in time where the central bank, the Federal Reserve, has raised interest rates, often raised interest rates aggressively, but it's not caused a recession. And it really comes down to the Fed deciding, given the inflation wages outlook, we don't need a recession. So we're going to stop raising rates, and we're going to pivot. We're going to start cutting interest rates. And so the late 1960s, the mid 1980s, the mid 1990s, and 2018 were examples where the Fed did raise rates, but didn't push the economy into recession because they judged that, a recession wasn't warranted. And in all of those episodes, the unemployment rate actually was steady. It actually didn't even go up all that much. So that's a soft landing. But as I said, at the moment, the unemployment rate is 3.5%. And my judgment is that you're not going to get a decent decline in wages unless that does go up. And again, historically, once the unemployment rate in the US goes up by at least 0.5%, it usually goes up by a lot more. A 0.5% move in the unemployment rate has historically triggered the economy going into recession. So a long answer, but good point about soft versus hard landing. They have happened in the past. But and the other, just on that point, what you often hear is, will the Fed make a policy mistake? Will they cause a recession even if they don't? It's not whether they'll make a policy mistake or not. It's whether they actually deem a recession as necessary to get inflation under control. Because historically, when they've had a soft landing, it's because the Fed desired a soft landing. And when they've had a recession, it's because the Fed didn't pivot quickly enough to stop it from happening. And that's because they were concerned about inflation.
Thanks, Dave. That's a really good answer. I guess following on from that, and there's been a few similar questions that I'll try and mix into one, but just with respect to fixed income and bonds, a couple of questions. Should I stay in bonds? But I guess more broadly, just your outlook in terms of where the bond market sits at the moment, and maybe the differences between fixed and floating in, say, a hard and soft landing, and where you could potentially take advantage of that.
Yeah, so I think, in fact, can I go back to the slides on? Oh, have I upset something? Sorry, bear with me for 1 second. I was going to flick back to a slide, but I think I've now upset things. Can everyone still see us? Okay.
Yep, we've just got your desktop still, Dave.
Now, well, let me just, I think bond yield, US bond, Australian and US bond yields, 10-year bond yields got up to 4.2% at their peak. They sold off, they've declined. Now they're back up to around about 3.8%. So I don't see them going back above 4.2%. So I don't think that level that we got to is going to be breached. In the short run, they may go a little bit higher because we are, again, particularly in the US, we've seen some stronger data. and the markets are now pricing in not 2 but 3 more rate rises. But broadly speaking, there's a the difference between further rate rises now and and the initial pricing in of rate rises last year is that we are sort of at the tail end of the tightening cycle. So the longer term interest rates that sort of look forward, even though the Fed is still raising rates, we're closer to the end of the rate rise cycle than we were a year ago. So I don't think there's as much upside pressure on bond yields as there was, this time last year. So as a result, I mean, I think fixed rate bonds are offering, pretty good value. Yields have picked up. I don't see them going up a lot further. And floating rate bonds, so they are fixed rate bonds. Floating rate bonds, the yields adjust to the market level of interest rate. So the capital value of floating rate bonds isn't as negatively affected by an increase in general interest rates as is the case for fixed rate bonds. So that's why you like floating rate bonds when you think we're in a rising bond yield environment. Now, the only challenge for floating rate bonds so if we're getting closer to the end, I prefer fixed rate bonds over floating rate. Floating rate was the story of last year. And the other issue with floating rate bonds is that if we do get an economic downturn, credit spreads, which are a bigger feature of floating rate bonds, do tend to widen. That actually then will hurt the returns on floating rate bonds, because our increase in credit spreads or the yield on corporate bonds, for example, or floating rate credit bonds, that hurts their capital values. So, so in a hard landing environment, you want to go fixed rate bonds. Even in a soft landing environment, I think fixed rate bonds do okay, not as well, but okay. In a no landing environment where there's a lot more tightening to come, then that's probably the least conducive for fixed rate bonds. But again, even in that scenario, I think we won't see bond yields go up to the same extent as we saw last year, because we are still, I think, closer to the end than the beginning of the rate rise cycle.
Yeah, and that sort of leads into a question from Hillary, just with respect to considering the uncertain outlook and the probable, let's call it a potential decline in the share market. Is there anywhere to invest in short term, apart from, say, Bear and BBOS, which are those short funds? I think that's a good question. I mean, from my point of view, you could have a look at something that traditionally would do well in a recession, like pharmaceuticals, that defensive type of environment, or potentially fixed or floating rate bonds to get a certain level of yield whilst removing some of that equity volatility in the market as well. Not sure if you had anything to touch on there as well, David.
Oh no, look, I think you're right. In a hard land, again, if the US has to go into recession, if we're still looking at a hard landing scenario, looking at another leg down in the equity market, fixed rate bonds are probably going to be the best investment in that environment, because yields will fall and they will do well. Floating rate, I mean, if you're worried about a no landing scenario, if you're worried about a repeat of last year where both bonds and equities remain under downward pressure, then cash is your best friend. The best asset allocation, particularly over the first 3 quarters of last year, was to be heavily in cash, because bonds and equities did well. So we have, obviously the AAA cash ETF. If you want to put your money into the market, Coupon, our floating rate bond ETF, QPON. So that won't be negatively affected by rising bond yields. Is another way to be defensive. Drug, but if you want to look at a defensive area of the equity market, something like Drug, our global healthcare ETF, is as Blair mentioned, has the defensive quality. So only problem with defensive equities, of course, is that we're talking about an area that may do relatively well, but it still may fall. I mean, if we have a bear market, the equity market sells off another 20–30%. Not saying that necessarily will happen, but if it does, something like a defensive equity exposure may still sell off 10%. It just won't sell off as much. So ultimately, in terms of defense, you're thinking about bonds and cash and those sort of things, to the extent you have that flexibility. Now, if you're, sometimes again, sometimes in the equity, when you read the financial press, for example, you've got, active managers, active equity fund managers who have to be invested in the market. Their mandate is they've got to be fully invested, or at least have, up to 90% of their money invested in the market. So in that situation, if you do face an equity market downturn, if you're bearish on the market, then yeah, having a defensive exposure is relevant, because at least that's an area that is going to probably still fall, but not fall by as much. So relative to your peers, you'll outperform, or relative to the broader index, will outperform. So defensive equity scenario, looking for defensive equity areas is more relevant when you have to be in the market, like a long-only manager. But if you're a self-managed super fund, a retail investor, you have some flexibility. You can obviously go to cash to some extent, or go to bonds. Again, the beauty of ETFs is that we offer all types of exposures now, and all manner of different asset classes, not just equities.
Another good segue, and thanks for that, Dave. That's a good overview. Just given where the dollar's at, you predicted US strength, particularly if we saw a US recession. In terms of hedged versus unhedged, call at the moment on that?
Well, again, so if you think the Aussie dollar is going to fall, then unhedged global equities are better than hedged global equities, because the foreign currency value of those exposures it holds up with a weaker US. So a falling Aussie dollar means that the foreign currencies go up relative to the Aussie dollar. So to the extent you want to play these things through hedged versus unhedged, I mean, that's of relevance. So if you think the Aussie dollar is going back to 60 cents or 62 cents, and you want to be invested in equities, and you're asking, is hedged going to do better than unhedged? Then unhedged will do better than hedged in that case. If you think we're going to have a soft landing and Aussie dollar is going to go up to 80 cents, and you want to get some global equity exposure, then you want to be hedged, because a rising Aussie dollar is going to take away some of your return if you're unhedged investing in global equities.
So Dave, we're quickly running out of time, but there's probably 3 more ones I want to cover. First, we'll touch on maybe just a very quick overview on your outlook for gold, if you have one.
Yeah, actually, and before I say just on that, I mean, and you do, as you mentioned, Blair, I mean, we do now increasingly have global equity exposures, both hedged and unhedged. So, for example, one of our most favorite popular ETFs, the NASDAQ 100 ETF, now we have both a hedged and unhedged version of that available on the markets these days, and it's true of many other different exposures. Outlook for gold. Look, I sound like a scratch record here, but I mean, everything in markets at the moment is really correlated and dependent on the US hard versus soft landing scenario. So if you can get that call right, all of these asset calls, you can get basically the broad direction of them right. So in a hard landing scenario, then what will happen is that bond yields will fall, which should help gold. But the US dollar, if the US dollar strengthens, that will hurt gold. So I think the outlook but gold can be a bit of a safe haven play as well. So I think the outlook in a hard landing scenario is somewhat mixed for gold. And I think gold is a very confusing asset to try to understand at the moment, because we had a period of inflation fears last year, and gold didn't do as well as people would have hoped, given the inflation concerns that were around. That was because bond yields were rising and the US dollar was rising. So those two factors were negative for gold. So I don't have a strong sense of what gold is going to do in a hard landing scenario. In a soft landing, what we've seen recently, gold has bounced back in a soft landing scenario because the US dollar has weakened. So if you get an environment where bond yields come down and the US dollar weakens, i.e. that inflation comes down nicely and central banks can cut interest rates, and support economic growth as a result, then that's an environment where gold will do well.
Great. Okay, last two. So and one from left field, which I think is interesting, is just any risks with the new central bank governor in Japan that you can see emerging?
Yes, well, I mean, I think they've had this long-term policy of like targeting, zero cash rate. They've had a yield curve control. They've been targeting 10-year bond yields, I think at like 1.5%. I think it's got, but it's a bit like in Australia. We had a bond yield target for a while there. It's hard to believe now, but a year or so ago, the RBA had promised to keep the yield on 3-year bonds at 0.1%. And then as global bond yields started to go up, it was a promise they couldn't keep. There was too much pressure and they let go of it, and then bond yields surged. And there is a risk that as Japan moved to lift their controls on their cap on bond yields, you may get some market volatility as a result. It may lead to some, an increase in Japanese bond yields in particular. But end of the day, I mean, I care more about the US. I don't think anything that happens in Japan per se, sort of interesting for the Japanese market, but it's not going to, apart from a 1 or 2 day wonder, I don't think markets are going to get too upset about it.
Great. And just very quickly, lastly, we talk about this mortgage cliff and mortgage repayment stress. Do you have any feel for when that may start to impact the economy, if at all, particularly, I guess, in Australia?
I think it's starting to flow through now. We're hearing more and more reports about, people having their fixed rates being reset. Again, so it goes back to COVID. Let's remember, 3 years ago, 2020, hard to believe now, 3 years ago, RBA slashed rates. You could get a fixed rate, for under 2% at one point through 2020. Now, if you took out a 3-year fixed rate, that's starting to be converted into a variable rate now. So depending on when you took that out, that's going to, play out this year. So I think it was probably a little bit early for a lot of that to happen, but certainly by June quarter, September quarter, many households who took out fixed rate mortgages during COVID will have their rates reset at a much higher variable rate, and that's going to cause some pain for households, and in aggregate have an impact. I mean, we're talking about 10% of households, but 10% of households that, if collectively they all, moderately had to tighten their belts, it will have an impact on consumer spending. Will it be enough to, in and of itself, cause a recession? No, I don't think so, because the 90% of households that aren't facing that can still be spending money. But it's one of the factors the RBA will be. I think one of the reasons I think the RBA is going to raise rates a couple more times, but then pause just to assess how that plays out. That's my base case at the moment.
Fantastic. Well, I think that's all we have time for. So once again, appreciate everyone joining today. Thank you very much for your time. Just to make it clear again, we will send around a copy of the slides, so you will receive that at the conclusion of this session. So look out for that. If there's any other questions, please feel free to interact with us and interact with David via social channels, via Twitter, and we can have a conversation on there. But thank you very much for your time. Hope you enjoyed it and have a great day.
Bye for now.